Now, let's talk about the FTX contagion and how it impacts Bitcoin miners. Core Scientific, Bitfarms, and Genesis Digital Assets are among miners that have direct and indirect exposures to the fallout. Bitcoin miners, which have already up to $2.5 billion in loans outstanding, could find themselves in even hotter water, as many have exposure to failed crypto exchange FTX and lenders such as BlockFi. Miners' balance sheets have been steadily deteriorating over the past few months as the price of Bitcoin has slumped, killing their revenue. Meanwhile, energy prices have soared, increasing their costs. This has resulted in one of the biggest mining data center operators in the US, Compute North, to file for Chapter 11 bankruptcy protection in September, while big players such as Core Scientific, Argo Blockchain, and Greenridge Generation have said they are in a liquidity crunch. The stock prices of all three publicly traded miners have plunged more than 90% this year. Now, some of the lenders working with these already struggling Bitcoin miners are in deeper trouble after getting caught up in the FTX blowup, potentially causing another major hit for the mining industry. ASIC financiers going through distress and bankruptcy will contribute to the cost of capital rising significantly in the space and access to capital drying up, said mining service firm Luxor Chief's Operating Officer Ethan Vera, who also estimated the total debt of up to $2.5 billion outstanding for the miners. If lenders go bankrupt, creditors are likely to try to liquidate some of the equipment loans, he said. In some cases, it might be too difficult for a bankrupt company to continue to operate a loan book, in which case liquidating these existing loans will result in a significant haircut, according to Vera. Not many miners have direct exposure to FTX assets. However, the crypto exchange contributed to a $431 million funding round for miner Genesis Digital Assets in September of last year. The company spokesperson didn't comment on FTX's investment, but said GDA had no assets or accounts with FTX. Genesis Digital Assets, is not related to CoinDesk's sister company, Genesis Global. Other key forms of exposures came from mining companies taking out large sums of loans from lenders such as BlockFi, Silvergate, and Galaxy Digital, all of which have some exposure to SBF's exchange. Still, considering that many miners are private and don't share their debt obligations or exposure, the impact of FTX implosion is uncertain. We don't know where all of the exposed counterparties are. And so for the industry, it's really going to depend on where holes show up. Jamie Leverton, CEO of Hut 8, said during the firm's third quarter earnings call. BlockFi became one of the many victims of FTX contagion and filed bankruptcy protection in a federal court in New Jersey. Now, to be completely fair, BlockFi was going to go under anyways, but FTX bailed them out. So, tomato. Should have ditched them a long time ago. If you didn't see that one coming, I guess you weren't watching the channel. Because we talked about it. We said it was coming. Regardless of what happened with FTX, it didn't even have to get related to FTX. It was coming. The miner, so this is for the lender holds at least three mining machine backed loans to publicly listed companies. Crucially, the $54 million that Core Scientific owes the lender. The miner, the US's biggest by computing power, is currently in talks to restructure its debt obligations that total at about $244 million in loans and $597 million in convertible and promissory notes at the end of the third quarter. A Core Scientific spokesperson did not respond to CoinDesk's request for comment on this story. Canadian miner Bitfarms also borrowed $32 million from BlockFi, but only about $22 million of that is outstanding as of the end of September. Meanwhile, Pierce Cipher Mining secured a $46.9 credit facility or joint venture, I think they mean million, with the energy firm Wind HQ, of which it owes 49%. So it's a 40 credit facility. Okay. These work differently. A Bitfarm spokesperson declined to comment on the story. The miner has been actively trying to reduce its leverage and said it paid down $27 million of Bitcoin and equipment-backed debt on November 14th. Cypher CEO Tyler Page said the company had drawn about $26 million of the BlockFi facility and never anticipated any further draws after a second one made in August. So it isn't concerned about BlockFi's issues. Less than $10 million of that is outstanding, and the joint venture continues to service the debt as expected, Page said. BlockFi and other lenders also hold undisclosed debt to privately held miners, which is hard to estimate due to non-disclosure agreements. BlockFi spokesperson did not respond to requests for comment on the story. Then we have Silvergate Capital. A digital asset bank and infrastructure provider said that of its $11.9 billion in customer deposits, only 10% belongs to FTX, and the bank has no outstanding loans related to FTX. The crypto bank also said that its BlockFi digital asset deposit exposure totals less than $20 million. Of the biggest publicly traded miners, Marathon Digital has drawn $100 million in total, equally from two Bitcoin-backed debt instruments that have a cap at $100 million each, said Marathon's Vice President of Corporate Communications, Charlie Schumacher. One is a term loan, and the other is a revolving credit facility, both with Silvergate Capital. Holy moly. One sec. As of November 9th, only 1,950 Bitcoin, about 30.6 million of Marathon's 11,440 Bitcoin, was unrestricted, meaning it can be used for business purposes, the firm said in its third quarter earnings report. If Bitcoin's price declined further, Marathon would have to post more collateral, hence restricting more of its Bitcoin holdings. The mining firm has decided to reduce some of its obligations given market uncertainty and volatility. And finally, Galaxy Digital. Michael Novogratz, Galaxy Digital, has $76.8 million of cash and digital assets tied to the exchange. The firm said it's in its third quarter earnings report. Let's see. Galaxy has been reported to be looking to cut nearly 62% of its exposure to FTX. Galaxy has also been active in lending to miners. Bitfarms is one of the miners that secured a $100 million Bitcoin-backed credit facility from Galaxy. However, after paying down parts of the loan and amending some of the terms, the outstanding balance is $23 million at the end of the third quarter. Galaxy's exposure to FTX hasn't impacted its services and offerings for clients, and the company continues to take a prudent risk management approach toward financing arrangements in the mining space, said the firm's head of communications, Mike Worththorne. There we go. Worththorne. Galaxy is not in distress, but other players that took significantly larger exposures will likely have issues, according to Worththorne. There we go. We are focused on secondary activity of ASICs, both from direct miners as well as lenders, and are in a good position to provide liquidity at good values for that equipment, he noted. During the third quarter, the Galaxy mining arm closed 3 existing machine leases, totaling about $8 million at expected terms without defaults, delinquencies, or losses, Worththorne added. The shares of Galaxy fell about 81% on the Toronto exchange this year. This is a nice wrap up. Bitcoin mining and staking firm Foundry has no direct exposure to FTX, but is indirectly tied to it through its sister company Genesis Global, which is owned by CoinDesk's parent company Digital Currency Group. Genesis said its derivatives business unit has about $175 million of funds locked up into its FTX account. DCG granted a $140 million equity infusion to the trading firm. A Greenridge spokesperson said it has an outstanding loan to Foundry, which is a fraction of the original amount, but said that its risk management strategy of liquidating Bitcoin mining revenue and removing all funds from exchanges daily was specifically designed to prevent exposure to exchanges. Bitfarms owes just about $1.5 million to Foundry as of September 30th. Foundry declined to comment on the story. Canadian miner Hut 8 said it paid off its debt to Foundry earlier this year and never drew from a $50 million credit from Galaxy, according to Aaron Dermer, Hut 8's Senior Vice President of Communications and Culture. Meanwhile, another crypto lender, NYDIG, said it has consistently passed on opportunities to invest in the likes of FTX. Similarly, financial firm BlockFi says that it has zero exposure to Genesis Global, BlockFi, FTX, or Alameda Research. All of this obviously gives us a good sum up of like what different crypto mining firms are doing and what the likelihood of them, going under is. That being said, a lot of people that we thought weren't going to go under are going under. And a lot of people, I didn't expect Cores to be in such a bad position that it now currently is in. I did kind of expect, the problems with Compass Mining. We've been seeing that one coming for a while. We've been seeing BlockFi come for a while. I didn't see FTX coming at the same time. I never really participated with FTX, so I didn't really have them on my radar to even pay attention to at all. Probably for the best, obviously. Of course, if I would have been paying attention, probably could have called out some of the red flags, kind of like we did with, BlockFi. That being said, when we talk about the Bitcoin cycle, there is something extremely interesting that begins to happen. In traditional business, taking out basically long-term, low-interest loans to acquire basically assets such as computer equipment is a valid strategy. But due to the way that cryptocurrency fluctuates every 4 years based on the halving of Bitcoin, it has thrown a lot of companies for a loop. And this traditionally kind of abused practice of having so much money that you can borrow so much more money ends up putting these companies that are trying to move, traditional business into cryptocurrency to fail. It's almost as if it was designed to make them fail. It was almost as if it was designed to make it fail, right? Which is extremely interesting if you start to talk about that from a philosophical viewpoint, especially as it pertains to why Bitcoin was created, etc. And now you compound that, with, of course, rising interest rates, rising power costs, etc., and it just makes it that much worse. It's really interesting to watch this play out. I'd like to hear your thoughts and opinions in the comment section below. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com, where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.